Welcome to 10th session of Management Accounting, 5th semester BBA, Bengaluru North University. In this session, we are going to study the liquidity ratios, meaning, types and their significance. In the previous session, we have discussed what are the classification of ratios. The main objective of this chapter is to familiarize the students with the ratio analysis as a tool for financial analysis. The main outcome of this session is that the students will be able to understand the various liquidity ratios and their significance. First, we will discuss what is the meaning of liquidity ratio. Liquidity refers to ability of a firm to meet its current liability. Liquidity ratio expresses the relationship between the current liability and current assets. It expresses whether the firm is in a position to pay off its liabilities on its due date. That is called as liquidity ratio. Next, types of liquidity ratio. There are two types of liquidity ratios are there. The first one is current ratio and the second one is the liquid ratio. The first one is current ratio. Current ratio is also called as working capital ratio. It expresses the relationship between the current assets and current liability. The formula for current ratio is current assets divided by current liability. Very important note you have to remember is current assets. What are the current assets? Cash in hand, cash at bank, bills receivable, debtors. When we are talking about debtors, we have to deduct reserves for bad and doubtful debts. Then stock, prepaid expenses, short-term marketable securities. Then what are current liabilities? Creditors, bills payable, bank overdraft, outstanding expenses, unclaimed dividend, dividends payable, income tax payable, provision for taxation. Next, significance of current ratio. What is the importance of this current ratio? The first significance is current ratio throws good light on the short-term financial position and policy. Second one is, it is an indicator of a firm's ability to promptly meet its short-term liabilities. And the third one is, a high current ratio indicates that the firm is liquid. High current ratio means more than 2:1 and has the ability to meet its current liabilities. Next, fourth one. A low current ratio indicates that the firm will find it difficult to pay its bill. Means if the current ratio is less than 2:1 means it is difficulty to pay all the dues. The last significance is normally a ideal current ratio is 2:1. It should not be less than 2:1 or more than 2:1. These are all the significance of current ratio. Next. There are few more significance are there. The sixth one is, if the current ratio is 1 is to 1, it means that funds yielded by the current assets are just sufficient to pay the amounts due to various creditors, and there will be nothing left to meet the expenses which are being currently incurred. Thus, the ratio should always be more than 1 is to 1. That is, for example, if current ratio is 1 is to 1, means current asset is also 1, current liability is also 1. And the next one is, a very high current ratio is also not desirable because it indicates idleness of funds, which is not a good sign of efficient financial management. Next, the second one, under liquidity ratio, it is divided into two types. One is current ratio and another one is the liquid ratio. First, we will discuss what is the meaning of liquid ratio. Liquid ratio is also called as acid test ratio, or it is also called as quick ratio. It is a severe test of liquidity of a company. It shows the ability of a business to meet its immediate financial requirements. What is the formula for this liquid ratio? Liquid ratio is equal to liquid assets divided by liquid liability, or quick ratio is equal to quick assets divided by quick liabilities. Note, what do you mean by liquid asset or quick asset? The formula for this is current assets minus stock minus prepaid expenses. Liquid or quick liabilities is equal to current liabilities minus bank overdraft. What are the significance of liquid ratio? The first one is, quick ratio is more rigorous test of liquidity of a firm than the current ratio. Then, when quick ratio is used along with current ratio, it gives a better picture of the firm's ability to meet its short-term liabilities out of its short-term assets. This ratio is of great importance of bank and financial institution. The ideal ratio of is 1 is to 1 to represent a satisfactory current financial position. Then it is the liquid ratio is less than 1 is to 1. If liquid ratio is less than 1 is to 1 means the business may find itself in a serious financial difficulties. Next, multiple choice questions. The first question is, liquidity ratio expresses the relationship between the current liabilities and dash. The options are current assets, current liabilities, quick assets, quick liabilities. The correct answer is current assets. Second question. Ideal current ratio is, options available are 1 is to 1, 2 is to 1, 3 is to 1, 4 is to 1. Which is the ideal current ratio? 2 is to 1. Next, third one. Ideal liquid ratio is, options are 1 is to 1, 2 is to 1, 3 is to 1, 4 is to 1. Which is the ideal liquid ratio? 1 is to 1. Yes, 1 is to 1. Next, fourth question. A dash current ratio indicates the firm is liquid and has the ability to meet its current liability. The options are low, high, both A and B, none of the above. The correct answer is high. The last question. Liquid ratio shows the ability of a business to meet its dash financial requirement. Options available are future, past, immediate, none of the above. The correct answer is immediate financial requirements. These are the books you can refer. Thank you.